What's up, you guys? Welcome back to my channel. Today, I'll be taking a deep dive into the fundamentals of the stock market. If you're new to investing or looking to enhance your knowledge, you're in for a treat. In this exciting video, I will cover everything from stocks to bonds to indices. So let's begin our journey into the heart of the financial markets. To start off, what are stocks? Stocks are pretty much known as equity. It's like a security that represents the ownership of a fraction of the issuing corporation. So you could say the units of the stocks are called shares, where it entitles the owner to a proportion of the corporation's assets and profits equal to how much stock they own. So to understand a little bit of the stocks, a shareholder is considered an owner of the issuing company determined by the number of shares an investor owns relative to the number of outstanding shares. So let's say a company has 1,000 shares of stocks outstanding and one person owns 100 shares. That person would own and have to claim to 10% of the company's assets and earnings. This is very important. Shareholders do not own a corporation, but corporations are a special type of organization because the law treats them as legal persons. So corporation files taxes, can borrow and can own property and can be sued. The idea that a corporation is a person means that the corporation owns its assets. So when we consider a good example, let's say Tesla. When you own Tesla stock, you're a shareholder. As Tesla innovates and grows, the value of your shares also can increase. So you're not just an observer, you're part owner of this revolutionary company. So we pretty much own a part of the company. So shareholder ownership is pretty much that they own their shares are issued by the corporation, and the corporation owns the assets held by a firm. So if you say you're one third of the shares of a company, it is incorrect to assert that you own one third of that company. However, you do own one third of the company's shares, which is pretty much known as a separation of ownership and control. So owning these stocks give you the right to vote in shareholder meetings, receive dividends, and if pretty much when they are distributed, and the right to sell your shares to somebody else. So it's very beneficial. So let's shift our focus to another key instrument. So with bonds, they're pretty much financial instruments that investors buy to earn interest. Essentially, it's pretty much they're buying these bonds, meaning that they're lending money to the issuer, which could be a company or government entity. There is always a predetermined maturity date. It could be a 1 year, a 2 year, a 3 year, a 5 year, a 10 year, a 20 year, with specified interest rates. So the issuer commits to repaying the principal, which is the original loan amount, and its maturity date. So in addition, during the time up to maturity, the issuer usually pays the investor interest at pre-scheduled intervals, typically semi-annually. So bonds are like pretty much debt securities issued by the corporation, governments, or other organizations sold to investors. So imagine purchasing a corporate bond. This is essentially a loan to a company. The company promises to pay you interest periodically and return your initial investment at the bond's maturity. It's a different way to engage with the market, offering a imagine purchasing a corporate bond. So it's pretty much exactly like it's explained right here, that it's essentially a loan to a company. It's like a more of a different way to engage with the market, offering a pre-deductible income or pre-deductible income stream. So it's like the bonds are originally served as a dual purpose in your portfolio. First, they provide a steady and more predictable income stream of regular interest payments. There's, like I was saying, there's corporate bonds, treasury bonds, and pretty much with corporate bonds are pretty much fixed income securities issued by the corporation to finance operation expansions. So it's pretty much, it could be private or institutional investors who buy these bonds choose to lend funds to the company in exchange for interest payments and a return of the principal at the end of maturity. So that's pretty much how corporate bonds work. You could say that for Tesla as well. If Tesla wants to issue a bond and they want to fund operations or their expansion for, say, their their Tesla automobiles or anything what they do with any additional with you could say with Twitter or now it's classified as X. And as in Treasury bonds, they're pretty much long-term investments issued by the US government. They have a maturity of 10, 20, or 30 years. These bonds are backed up by the US and therefore regarded as very safe due to the low risk. They offer lower yields than other types of bonds. So it's pretty much very unique to have bonds into your portfolio. So to grasp the market's overall performance, we turn to indices. These benchmark represent different market segments, which is going to be I'm going to show you guys a little video, a little clip.
A market index represents an entire stock market, providing a benchmark to track a market's changes over time. Investors use index values to follow market trends and other developments.
So as you can see in the video, it's pretty much discussing as with the indexes. So if you talk about the Dow Jones Industrial Average or the Dow, for instance, tracks 30 major US companies. So as we visualize with the video, think of the Dow Jones as a snapshot of the market. When it rises, it suggests that 30 major companies are collectively thriving. When it falls, it signals a potential downturn. It's a barometer for market health and sentiment. So what is a market index? A market index is like a hypothetical portfolio of investment holdings that represents a segment of the financial markets. The calculation of the index values come from a price of the underlying holdings. So some indexes have value based on the market cap weighting, revenue weighting, floating weighting, and fundamental weighting. Just follow different market indexes to gauge market movements. The three most popular stock indexes for trading performance of the US markets is Dow Jones, S&P 500, and the Nasdaq. So as you can see, pretty much how does it really work? It's pretty much to understand that each of the index has its own methodology, which is calculated and maintained by the index provider. Of course, there's many different indexes for different stock markets. There's a stock market for the London Exchange, for the Berlin Exchange, the Swiss Exchange. So of course, there's many different types of indexes that are maintained by their provider. So they just help pretty much help typically by weighing either by the price or the market cap. So as you can say, market indexes is pretty much classified as benchmarks. You, as previously mentioned before, other indexes have more specific characteristics that create a more narrowly targeted market for focus. For example, indexes can represent micro sectors or maturity. In the case of fixed income, or indexes can also be created to represent a geographic segment of the market, such as those that track the emerging markets or stocks of the United Kingdom and Europe. So the FTSE 100 is an example for such index. You can see there's also a few examples of what type of indexes are out there. So some of the markets leading indexes include the S&P 500, the Dow Jones, the Nasdaq, pretty much the US aggregated bond market, global aggregated bond market. So investors often choose to use this index investing or other individual stock holdings in a diversified portfolio. So investing in a portfolio of index funds can be a good way to optimize returns while balancing risk. So we're going to go ahead and talk about pretty much the benefits of investing. So with the basics covered, let's explore why entering the stock market could be adventurous. So I would say there's three type of keys that I would recommend that would be usually the potential for growth, the dividends is income, and a hedge against inflation. Of course, nowadays we're in an inflation market. We'll see how the Feds react pretty soon if it pretty much the whole crisis that we're having around the world. But investing in stocks provides pretty much the potential for growth. Suppose you invest 1,000 in a stock, or over time it appreciates. Your initial investment could turn from 1,500 to 2,000, even more. So it's a way for your money to work for you. And when it comes to dividends as income, stocks can also generate income through dividends consider the companies that pays dividends, like you could say Apple, Google, Microsoft. As a shareholder, you receive a portion of this company's profits regularly. So it's a keen to earning shares of a company's success. And the last one we would consider will be the hedge against inflation. As I was mentioning, inflation is a big issue at this given time. So stocks can act as a hedge against inflation, even with cryptocurrency like Bitcoin. Unlike some fixed income asset, stocks have the potential to grow in value, helping preserve your purchasing power over time. So as we wrap up our exploration of the stock market basis, remember that investing is a journey unique to each individual. If you found this video helpful, please give me a like, subscribe, and share your thoughts in the comments below. Happy investing, and I'll see you in the next video. Thank you so much. Thank you.